Hi, everybody. Welcome back to the spotlight of this next masterclass. And today we'll be discussing why depressed markets are the best time to go shopping. And first and foremost is housekeeping. And Amanda, you go.
Alrighty, let's get started. Welcome back. Hopefully, this is one of many Spotlight Masterclasses that you're catching. So we'll keep this a bit quick. We do not replace your broker or your accountant or any of your other professionals. Everybody serves a purpose. We are just one member of your team. So your broker and your accountant, they are your gatekeepers to finance and tax laws. So please make sure you keep them close. We are your strategic partners as your buyer's agents. So please do have a read there of our legal disclaimer. We have not done an assessment of your individual circumstances. We are pitching to a broader audience with these Spotlight Masterclasses. So the information that we give out is based on essentially what we find are the questions or concerns that come up the most when speaking with our clients. Of course, some of those will apply to you, some of them won't. Use your discretion. And of course, if you want a more personalized experience with your particular circumstances taken into account, you can book a 15-minute call with Dragan, which we'll show you how to do in a moment. But first, this is topic 10. So if you've been watching these in order, congratulations, you're nearly there. You're almost at the end. If you've been picking and choosing and, picking topics based on your interest, and if this is one that has interested you, welcome. So as you may or may not know, these Spotlight Masterclasses work in pairs. So today's masterclass, why depressed markets are the best time to go shopping. This one pairs up with why booming markets are the best time to leverage. So as a pair, these masterclasses go with, if you've already seen the timing the market masterclass. So where you can see there topic 3, using the property clock to time the market or using time in the market to guarantee growth. This goes with webinar 1 of topic 3, using the property clock to time the market. So what we've done here is we've found that there are a lot of questions from people that were interested in knowing how market fluctuations should impact their buying and selling habits. So we zoomed in a little bit on some of the topics that we discussed in that masterclass here. So why depressed markets are the best time to go shopping is what we'll be looking at today.
Exactly. And guys, feel free to scan this QR code if you would like a one-on-one 15-minute discovery call with myself to discuss any strategies or any questions you may have in regards to what you see so far or have seen in the past. Alternatively, you can I'll start that again. Alternatively, you can go to propertysessions.com.au/15 and book it that way as well. So a little bit about myself, if you haven't heard already. I'm going to keep it brief this time. So background is my parents migrated from former Yugoslavia in the 70s to Australia. Grew up as the only child here we go again. Grew up as the only child in commission housing in a suburb called Redfern in Sydney. I'm sure some of you would have heard of it in the past from the news, but anyway, it's all good now. So loving parents, which were all great, but obviously I was one of those children that had little in comparison to the people around or the students around me or the kids around me. And obviously that sort of grew a bit of a spark for me to, have a bit more of a desire of wanting and achieving as I got older into my adulthood. Started my photography business in my early 20s, and from then on, pretty much started investing in property. And fast forward 20-something years later, I'm teaching my kids what I've learned over those years for what to do and not to do. So over to you, Amanda.
Thank you. Well done. If you've been watching these, you'll be familiar with these introductions. We introduce ourselves each time, and it's always bags of fun talking about yourself.
Especially when I screw it up. Anyway.
Oh, well.
Anyway.
For me, I always try to take a different angle when talking about myself, and I'm running out of angles now that we're at the end of the road with these. But for me, I suppose you could say that I'm in the position of Dragan's kids, where I'm the beneficiary of the wisdom. Somebody else has made the mistakes before me. Not necessarily just my parents, but, the broader family or, I come from a family of investors. Some more than others, some are more aggressive or some are further down the road than others. But generally speaking, everyone in the family is fairly like-minded. So for me, there's always somebody to ask or somebody to talk to or somebody that's already done the thing that I'm wanting to do. So it's not just learning from their mistakes. Mistakes is probably a little harsh, but learning from their wisdom, because there's always somebody that's walked the path ahead of you. And I'm quite fortunate that I've got a lot of people to choose from to ask, whether it's my parents, an auntie, an uncle, a distant cousin. There's always somebody around, because everyone was sort of raised the same way, bricks and mortar. They don't really understand stocks. I don't think I could name anyone that's really into the share market in my family. It's all property. So it's been ingrained in me from a very young age, um, to the point where it was sort of an expected path for me. Not that I didn't feel I had a choice. Well, I didn't have a choice, but it was always just one of those things where, you go through life, you go to primary school, you go to high school, you go to uni, you get a job, you get a trade, you get married, you have kids, you buy a house. Like, it's just one of those things that it was baked into what I thought adulthood meant. So I followed the path blindly in the beginning because for me it was just the next step. And then as I followed the path, the buy-in began after, the mental buy-in and the mindset buy-in started after my first purchase. So if you've seen the other spotlights, you'll see that I was coerced into my first purchase by my very aggressive parents. But for that, now I'm grateful, because in my case, I had to be thrown in the deep end. And that's pretty much how I learned everything important in my life. My dad threw me in the deep end. One day I'll have to tell you the story about how he taught me to drive manual. He waited till you were allowed on your green peas to drive past. So I got my reds on an auto. On my greens, he just said, here you go, figure it out. Made me drive to uni, peak hour traffic. At the time I was at Macquarie Uni, Epping Road is like this. Peak hour traffic, hill starts, never driven a manual in my life. Had to make it all the way to uni from Kenthurst. That was fun.
But that's funny, because I've actually got a story about that as well, about how I learned how to drive manual.
Were you thrown in the deep end?
No, I actually threw myself in the deep end for a job interview, and they said to me, "So do you know how to drive manual?" I was, yeah. And off I went into a van. I'm doing this all the way up. And they're like, "So, do you know how to drive manual?" "Oh, it's just the clutch is a bit sensitive." And off I went into the city. Anyway, that's another story for another time.
But property investing is the same. Sometimes you got to drive in the deep end, and if you have to sink or swim, you'll be surprised at how well you can swim.
Learn quick.
You
believe
learn
me.
quick.
Or you hit a brick wall. No, right.
Fortunately, I didn't have any accidents, but I think I cried the whole way to uni, and I got to uni like, oh, I nearly died, but made it. All right.
Okay, let's get into this.
All right, what is a depressed market? So before we can even get into how to, use a depressed market to your advantage, you need to know that you're actually in one. It's one of those things where it sounds really obvious, but often we don't realize until it's already passed, until we have the benefit of hindsight. Oh, that was a dip in the market. We've all done it where we've gone, oh, that was the bottom, I missed the bottom, or oh, that's what the market was doing, because hindsight is 20/20. But when you're actually living in it, the fear or the media rhetoric or the conversations at the family barbecue might not always recognize it until after the fact. Because in a depressed market, you have people, going, oh, there's going to be a massive correction and prices are going to drop another 30%. But that another 30% never comes. You're actually at the bottom when you thought that. So it's not until the uptick and the recovery is already well underway that you go, oh, that was the bottom. So knowing that you're in a depressed market when you're actually in the thick of it is really difficult to tell, because there's a lot of noise going on and there's no real way to confirm it until after the fact. So the only real way you can kind of determine in real time if you're in a depressed market is using our good old friend, the property clock, who you've hopefully already met in those other Spotlight masterclasses that I spoke about. So I won't go back into understanding the property clock in depth, but you can kind of see visually there that it, looks at the progression of the markets. And the main point that you really need to understand here, if you haven't seen the other masterclass, is just that the clock doesn't move in a rigid fashion. It's not like every increment is the same length of time. We might get from peak to decline in 6 months, but then from declining market to a rising market in 6 or 7 years. So it doesn't move equally around the clock, but generally it will follow that progression. So when we say depressed market, I'm generally talking that 5 to 7 p.m. So we're sort of straddling the 6 at the bottom, 5 till 7 p.m. You kept a straight face through that.
I did. It's a joke. I'm sure you guys will figure out.
Blue for real. He always laughs when I use the word bottom. So I thought if I said straddling the bottom, I'd get him, but he held on.
Oh boy, it feels like back in high school, primary school.
Do we cut that or keep?
I know.
You make the call. We're having fun. We're having fun. Okay.
What actually happens in a depressed market?
Yeah.
And
I love this. I love people watching, and I love watching what people do with different influences impacting their mindset. I love it. It's fascinating. So there's a few things that go on in a depressed market, and what we've done is we've split that up into the buyer side and the seller side, but also the real estate agent side, because remember, a real estate agent only gets paid when he makes the sale. The commission is only payable on the sale price. So to get a sale price, he has to sell the property. So in a depressed market, properties are really hard to sell. So there are certain things that happen, certain forces, certain pressures that sort of all interplay between these three parties. I'm getting the hiccups from this hot chocolate. Okay. So on the buyer side, so this is sort of us, but when I say buyer, I'm also including owner-occupiers in there, not just investors, because as investors, we're bargain hunters, right? We're not emotionally attached to what we're buying, we're just following the numbers, whereas an owner-occupier is probably a little bit more emotionally driven. They'll buy a property because they love it, not because of the rental income. They don't care about the rental income, it's not relevant. So when I talk about the buyer side, there's a lot of emotion on the buyer side, particularly when the market has a lot of owner-occupiers participating. So on the buyer side, when we're in a depressed market, there is a fear of overpaying because the market's potentially dipping or finding the bottom. People don't want to pay too much money because we have a lot of doom and gloom in the market. People don't know where the bottom is, how much further down that market's going to dip. So people fear paying a premium price in a depressed market because they don't want negative equity out the gate. Particularly depending on their loan size, if they're borrowing 90 or 95% and then we dip another few percent, that LVR gets very hairy very quickly. So we have fear of overpaying or trying to catch a falling knife. So if you imagine the imagery of trying to catch a falling, and when do you perfectly catch the bottom? You get cut trying to catch a falling knife. Sometimes, particularly a Dragan strategy, is sometimes you wait for the little uptick so you know that the bottom has passed. And even if you just buy a little bit up the uptick, you might pay a little bit more than the bottom, but at least you know that the bottom has passed.
yeah, that's right.
The other one there is, you might have heard the term lowballing. I don't know how appropriate it is for me to repeat it there, but it is the term used.
Yeah, that's fine. Let's continue.
Or I sometimes call it dart throwing. I personally like dart throwing. There's a difference here, okay? So lowballing is when you're just putting ridiculously, offensively low offers and hope that at some point there's going to be a vendor desperate enough to take it.
Yeah,
Right?
look, in saying that as well, you could actually, excuse the language, but you actually piss off the agent and lose the offer in total for them not coming back to you if you go too aggressive as well. Okay.
Yeah. In a depressed market, there's a bit of game playing, right? Because nobody's desperate until we get to the agent who needs his commission. But buyers and sellers, nobody's desperate. Now, the other method there that I personally like is dart throwing. So imagine the imagery of just throwing darts at everything, right? And you just basically put in offensively low offers on everything, as many as you can. And if something sticks, great. If it doesn't, who cares, right? Now, we get this question a lot. People worry, oh, but if I have an offer out on that property, and that property, and two of them accept my offer, then I've bought two properties. No, you haven't, because you haven't signed anything yet. All you're doing, even if you put it in writing, if the agent says, I'll put that in an email, it's still not binding. You still haven't signed anything and you still haven't had the other side. So you haven't exchanged contracts. It hasn't gone to your conveyancer yet. So if you, do the dart throwing thing, you're not bound or anything like that. So don't fear. I think people fear that because they worry about committing to more than one, or they don't want to have the tough conversation with the agent when they pull their offer on the one they don't want because their dart hit on the one that they do want. The real estate agent won't even remember who you are after that phone call because they're already bringing the next buyer trying to sign them up. So don't worry about that. Okay. So as I said, urgency has left the market. Buyers are being pickier. There's generally fewer buyers competing for properties. So the power of negotiations in a depressed market is with the buyer. So for the seller's side, what does this mean? If you think of the psychology for the seller, right, they've missed the top of the market because the market's heading down. And generally from the top to the bottom, you're talking maybe a year, 18 months tops, right? So it's fresh in the seller's mind, the top of the market, because it wasn't that long ago. Okay, it doesn't take long for a market to correct, because all it really means is that the heat's come off the boom. It doesn't mean we're heading into a big dipper. It just means the heat's come off and then we plod along for a while until the next uptick. So usually for the seller, those top dollar prices are still well within their memory, and they convince themselves that they can still get those prices. So they're pressuring their selling agent to try and get that top dollar price that they would have got a year ago if they had sold them. So what happens for the seller is that they hold out for this price, but they're not getting it. So for the seller, they need to learn or to accept that they need to meet the market. And that might mean dropping their price expectations a little bit. And that takes time for a vendor to accept that, because when they go to market, they've looked at the price they want and they've gone, oh, I'm going to pick the best agent. The agent has, said whatever the agent has to say to get them to sign the agency agreement. And then once the agent has them signed up, he'll start conditioning his buyer lower after that point. Okay, he'll make all the promises to sign them up. Once they're signed up and they're getting a bit frustrated with the market, then the agent will start saying, oh, maybe we need to drop the price. Oh, maybe we need to meet the market. Oh, we haven't had the interest we thought we'd have. Oh, the open homes have been a bit quiet. Then he'll start working on his vendor. Not too soon. Okay, so what does this mean for the agent? The DOM stretches out, so days on market. The longer a property is on the market, the more fatigued your vendor is going to become, because a property is hottest in the first couple of weeks, because that's when people are showing up to the opens and looking at it. Once it's overexposed and it's been on the market too long and those days on market clock up, there's an obvious and clear lack of interest, and buyers can see how long a property has been on the market. So once you clock up, closer to that 90 days, when you know that that exclusive window that agent has that property for is closing, then not only do you have a fatigued vendor, but you have an agent that knows that his commission is slipping away. He will have done 90 days worth of work and earned nothing for it if he doesn't sell that property. So that 85th, 86th, 87th day, that's when you hit the agent hard, because he knows he's about to lose that listing and he can salvage his commission at whatever price he has to sign you up and get his vendor over the line. Okay. Now, the even better scenario there is if it's not the first listing agent. So let's say it's a listing where the first agent's run is 90 days, the vendor's still not budging. They go, you can disappear, mate. I'm going to get another agent. I'm going to get a better agent, right? So then they sign up a second listing agent. Second listing agent can't sell it either because the vendor still hasn't figured out that the market's moved and they've got to drop their expectations. Okay, they might be up to their third listing agent. By this point, 90 days, 90 days, 90 days, they've been on the market, 6 to 12 months. They're wanting this place sold, right? Because to get to their third agent, they obviously need to sell or they really want to sell. So if you see something that keeps relisting with new agents, go hard on those ones, because you know that your vendor is fatigued. And a fatigued vendor is what we call a conditioned vendor. Okay? And if you want to be a bit of a, are we just seeing up language today? I feel like I was going to say, if you want to be a bit of a-hole, I like to
A bottom hole. So
that I should have said a bottom.
anyway,
Got to be a bottom hole towards a bottom feeder. If you know that they're the third agent, you can sort of try and buddy up to the agent a little bit and go, oh, I noticed you're the third agent. It was with so-and-so and then it was with so-and-so. Oh, you've got it this time. So you've got a conditioned vendor. And if you start using language like that, the first thing they'll ask is, oh, are you an agent? And you go, oh, no, I just figured your vendor would be fatigued. And you sort of use their language, but you deny where you've got that language from. So they don't know who they're dealing with. Am I dealing with a buyer's agent, a real estate agent, a mum and dad investor? Who am I dealing with? You sort of throw the agent off a little bit by speaking their language, because then they don't know how to deal with you. But again, that's only if you want to be a bottom hole. And then, of course, when the agent is desperate, they'll follow up on all inquiries. So if you're one of the people that looked at the property in the first week of the 90 days and then it's still on the market in the 11th week, they'll go back through all of that and they'll start ringing everyone. So if you get a phone call, 2.5 months after you've looked at something, they're desperate, throw a dart at it. See what sticks.
Yep, definitely. How does this impact you?
Yeah, so we talked about buyer, seller, agent. What about investor? What happens on the investor side? So in a depressed market, vendors typically will only sell if they have to. So things like deceased estates, often, the kids might all be living, one might be in WA, one might be in Queensland, they might not be nearby. So they've just rung a local agent to list it. Even better, if the place needs cleaning up or emptying out, you might get a really good little deal there, especially if an agent is aware of you. Excuse me, this hot chocolate's like coming back up. If it needs cleaning up or if it needs work of any kind because it is a deceased estate and they weren't planning to sell it, or, the death was unexpected, then you can pick up a bit of a bargain there, particularly if the kids live away. Mortgagee in possession or distressed sales, they'll usually go to auction. But again, they need to sell. They don't have the luxury of waiting, so they can be a good opportunity. Sometimes if they're selling due to divorce, again, they need to cash in and take their half each, so they have to sell. And if the vendor has already purchased elsewhere, then their clock is ticking because they need the funds to settle on their new purchase.
It's always good to probe them with questions and find out exactly what their reason for sale is. And knowing the reason will give you a vantage point of making this particular offer for the property. So when agents actually give myself a call, they're usually, as I mentioned this on another spotlight, they're usually calling a buyer's agent because they need to have quick action of sale. They're not here calling me to get the best possible price. So first thing I ask is what's their reason for sale. As soon as I hear it's a mortgagee in possession, financial stress, divorces, call it a light bulb, I guess, pops up on top of my head and I go, okay, great. Well, it's not a light bulb, is it? It's more of okay, now I know I can actually go hard on this negotiation.
So when you ask why they're selling, you're not asking to be nosy. You're actually running an assessment of how urgent the sale is.
Yep.
Mm.
So that way, then you can come and obviously you would have done all the research in that area, knowing what this value of this property should be worth, and that's when you go under market value on an offer.
Yeah, especially when the market's already dipping and the agent is in the vendor's ear going, the market's still going down.
Yeah.
Take this while it's on the table.
Exactly.
And remember as well, if one of those reasons for selling doesn't apply, many vendors will hold on to their property for as long as they can. So sometimes as well, it's about knowing when you're wasting your time, particularly if a vendor is just testing the market, or if they, wait till the absolute last minute before they have to sell, before agreeing to a price cut. So sometimes doing that assessment on why they're selling can tell you how much time and effort you should actually put into that negotiation. Because if the vendor isn't serious about selling or desperate to sell, and if they can hold on, they likely will in a depressed market.
And here's the other thing as well. Selling, I get a lot of people asking me a question. So why would the agent come to you if they can get the premium price? Well, an agent for many reasons will actually prefer to sell it off market. First of all, it makes them look good for the next customer. The other reason is if they can have a little bit of a discount. Let's just use an example of, say, $700,000. The value of that property, $700,000, and you're offering $660, for instance. 2% of $40K is only, what's that? I haven't got my calculator, but it's not that much. They're going to save their marketing costs, pocket that money, save time, not having open homes, and they're happy to talk the seller, the vendor, into that sale, right?
There are many reasons why people
That's only one.
sell off market.
Yeah.
I've sold off market before. I mean, we talk about, selling off market can get you a discount, it's got to be a quick sale. But it doesn't always have to be. If I can deviate into a very quick story of a time that we sold off market, it was an unexpected purchase. This is not investment. This is where we live. And we had committed to actually building our dream home. We had the plans. We were in council. We were awaiting council approval. And it was our dream home. We're like, this is it. This is our forever, blah, blah, blah. But then before we started building, before council had approved our plans, something else came up and it was perfect. It saved us the hassle of building. And my husband and I looked at each other and we thought, we've got this block of land, like we're committed. Do we jump ship, right? The only way it would work, because at the time it was when building costs were skyrocketing and people were scared to buy vacant land. If you remember during COVID,
Yeah.
vacant land was like the worst thing you could buy.
I was building at that time.
Yeah. And this is the thing, right? Like we were insulated from the rise in building costs because we're related to the builder, but the land, I thought we can't offload this if we buy this other house. So we said to the listing agent, the only way we can buy the house is if you sell the land at the same time and we do an exchange at the same time on both transactions. So I said, you have to sell it off market and you have to sell it like now. And we actually didn't negotiate a purchase price for both. We negotiated what's called a changeover price. So I said, as long as the gap in price between the two contracts is this much, I'll sign both contracts. So he basically ran around like a headless chook trying to find, a buyer. We didn't have time to put it on realestate.com. He just, ran around like a headless chook to find a buyer for our land at that price, get his vendor on the house for the other price, for them to agree to the gap in price. I was not part of the negotiations at all because I just said, get me that changeover price, we've got a deal. He did it all, put the two contracts in front of me, and I signed them. So sometimes there are legitimate reasons why people sell off market. In that case, I guess you could call it a distressed sale in the sense that I didn't want to be left holding the bag on a vacant block of land in that market. So it's not that you're buying inferior stock. I don't want people to think, if it's off market, it wasn't good enough for the market. It's just circumstances more often than not.
And you've got other people that have just purchased a property and they need to sell that property they're living in to fund the other.
Yeah.
And sometimes, they're happy to take a little bit of a haircut on that price because they've lived there for 20 years. They've paid $170K for it. Now it's worth 800. They're happy to take 750.
Yeah.
You're not screwing them over. It's just circumstance that
the instructions, the agent represents the seller, right? So it's the instructions that the selling agent is given. So in my case, the instruction he was given was, I don't care what the price on the contract is. This is the changeover price that I want when I buy one and sell the buy one and sell the other. So he could have put whatever number he wanted on those two contracts because I was negotiating on a changeover price, not a sale price or not a purchase price. Now, the lady that bought the land, I personally think she paid way too much for it. But you know what? The market moved again and she ended up winning. So at the time, we thought we won, but the market just kept going. So, I don't know what she paid for the build or what happened after that. But at the end of the day, if someone's prepared to pay it and the agent can get the price higher or lower, and both parties are happy to sign that contract, then nobody's been taken advantage of because everyone's been represented by an agent. If you've got a buyer's agent, you're represented. If they've got a selling agent, they're represented. Everyone's happily signed the contract. It's a done deal.
That's right.
Okay. So we said their vendors will hold on as long as they can if they don't have to sell. So what we find there is the market looks for its floor. Okay. So how low can the market get before vendors go, no deal, I'm not selling, I'm going to hold on and wait for the recovery? There will always be a floor because there'll come a point where selling is no longer the better option. If the market dips too much, it's actually more viable for vendors to wait it out. So once that floor in the market has been found, we might sit at the floor for a few months and then the uptick will begin. Okay. So remember we said this is between 5 and 7 on that property clock that we're looking at in this masterclass.
Yep.
So what you need to do is work out which properties are worth chasing while the market is looking for its floor. So this is the time to do the dart throwing thing that we talked about because a lot of properties will be on the market for a long time. We talked about DOM, days on market, stretching right up. It's not like a boom where stock goes like hotcakes, pancakes, whatever they're called. I was going to say handcakes, N6. Stock flies off the shelves. Whereas in a depressed market, it sits on the market for a much, much longer time.
Yes. So which properties are worth chasing, Amanda?
Which ones do you go for in a depressed market? So we've already said the ones that are up to their second or third listing agent. A fatigued vendor is really great to negotiate with because they've missed out on higher offers and those buyers have moved on. And then suddenly your offer $30,000 less looks pretty tempting. They might not have considered it 6 months ago, but now they will. So here you are with your offer ready to go. Vendors selling due to circumstance rather than choice. Circumstance introduces urgency, so they're more likely to put pen to paper and sell compared to choice. If they have the choice to wait and the market looks like it's going to recover soon, they'll probably wait. So again, like Dragan said, ask the agent why they're selling. If it says sell due to circumstance, then it might be worthwhile. And of course, limited competition. In a depressed market, you do have limited competition because a lot of buyers are scared. We talked about the fear of overpaying. So there's a saying that says, be greedy when others are fearful. It kind of applies here in the sense that if people have left the market, it's not because the market's necessarily risky, it's because people don't see enough certainty. But again, the market is a live thing and it's often a self-fulfilling thing. So people will pile back in once that floor has been found. If you can nip in just before that competition increases, you can, hopefully do a lot better and secure a bargain. So that depression window in the property clock, 5 to 7 p.m, as long as you can hold up through the rise, that's a really good time to go shopping if you use the strategies that we talked about today. Get your darts out. Start strong.
That's right. Thank you, Amanda. And guys, again, you've got the QR code up here, so please book in a call if you have any questions. If you want to discuss some strategies, whatever it is you need, 15 minutes you have with myself directly. Otherwise, go to propertysessions.com.au/15 and feel free to book there. See you soon.
See you later.